Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got Dean Orico, CEO, President of Middlefield with me, and we're going to talk about real estate today and what's going on with REITs and real estate. Dean, thanks so much for doing this. How you been?
I'm doing great, Adriano. Thanks for having me on.
I
Appreciate you
appreciate
reaching out.
I appreciate you coming on such short notice to talk about something that I feel you're an expert in, right? When I think real estate and REITs, I always think Middlefield. So first, let's just start off with real estate REITs in general. Had a pretty bad time so far, and I think a lot of investors are asking why, because rates are actually going down, especially in Canada. I guess maybe we could focus more on a little bit in Canada, but I think it's even in general, even the US REITs, I believe, are struggling a little bit. But rates are going down, right? Bank of Canada just announced another 0.5, right? And this is, as far as what we're told, supposed to really help REITs and real estate because now borrowing costs go down. So can you tell us really what you're seeing in terms of the real estate or REIT market right now?
Sure. Um, so let's talk about 2024, kind of over the past 12 months, what's transpired. So, we've been maintaining for at least the last few years that the fundamentals in the core areas that we're invested in, so specifically we're talking about open air retail, grocery anchored retail, industrial, multifamily, seniors housing. They're all fundamentals are all right across the board, really, really strong. So that's really been the backdrop for the last few years. But with the rate hiking cycle that we saw, investors were choosing to invest in cash-like instruments and GICs and money market funds where they were getting 5 and 6% yields that they hadn't seen in a generation. So money left interest-sensitive areas like REITs and utilities. That started changing in June, July of this year with the Bank of Canada, as you mentioned, starting to reduce rates. And we've also seen the central bank in the US reducing rates, Europe and the UK is reducing rates. So that started to happen across the board. So you started to see a real bounce back in REIT unit prices beginning July, August, September. And you might recall, I was calling it a bit of a coiled spring up until that point. And not surprisingly, that's exactly what happened is that these prices really ran up. And then the air came out of the REIT market in late September, October, because in Canada, two things, and one thing in particular really took place. One, the federal government, with pressure from a number of Liberal MPs, came out and announced that they were going to be reducing immigration targets. So early this year, in fact, they announced a reduction in non-permanent residents. And then in late September, October, they announced a reduction in permanent residents. And as we both know, Canada has had the highest level of immigration of any country in the G7. Roughly speaking, we had about 2 million new people come to Canada just in the past 2 years. On a population at the time was about 39 million people. That was very significant. And that really drove a number of issues for Canadians where, we didn't have the infrastructure to support that level of immigration. And that really became a very hot political topic. So as a result, a lot of Liberal MPs, seeing that the Liberal Party was so far behind in the polls, basically convinced Prime Minister Trudeau to come out and reduce those targets. So with that announcement in the last couple of months, you saw a lot of money come out of REITs, in particular the multifamily REITs.
Mm.
And as I sit here today, I really believe that the reaction by the market, and specifically foreign investors who are investing in REITs, I think it's been overplayed. I think this has driven an opportunity in REITs that I think is extremely attractive because on average right now, we're seeing the Canadian REIT market trading at about a 20% discount to NAV. And as you say, Adriano, short-term rates have been coming down. In Canada, we even have the 10-year bond rate, which is also something that investors look at and the REITs certainly focus on. That's now down to 3.2% or so. Um, as distinct from the US 10-year bond rate, which has actually gone up again back to about 4.4%. So that's up significantly since mid-September. So while the Canadian 10-year bond rate is down, and again, that's helpful for REITs, US investors, who are a major factor in the Canadian market, they're seeing higher bonds, higher bond yields in the US, and again, making them less inclined to invest in things like REITs. So immigration, the US 10-year bond, those have been the primary factors behind some of this more mediocre performance that you've seen in REITs in the last 2 months. And again, I think those issues are about to change. I think number one, the worst case scenario on immigration is already priced into REITs, in my opinion. And again, you're seeing some areas trading at a 30% discount to NAV, like some multifamily REITs. The whole sector on average, as I mentioned, is trading about a 20% discount to NAV. We know rates are not going higher. We just printed inflation in Canada of 1.9%. So yes, the Bank of Canada cut by 50 basis points. I think you're going to see several more 25 basis points cuts in the new year. So again, that helps balance sheets, that helps REITs in terms of renewing debt or short-term debt that they've got on the balance sheet now being at lower rates. And I think that's also going to be providing some impetus for larger investors, private equity players, or even some public REITs coming into the Canadian market and looking at these valuations saying, we need to buy something. These prices are too attractive, especially now with rates being lower. So as I sit here today, I'm looking at 2025, and I'm thinking that you're going to see a really good market for REITs because, again, the fundamentals are great. Interest rates are coming down, so that not only helps the REITs in terms of financing opportunities, but it also convinces investors who've been sitting in GICs and getting 5 and 6% are no longer able to get that rate. They're probably looking at something closer to 3%. So I think that then becomes a tipping point for all of this money that's been sitting in GICs and money market funds to come back into things like REITs. So I think all of those factors together are making me, very constructive on the outlook for 2025. And again, it's all underpinned by extremely strong fundamentals in those core areas where we have exposure.
Okay, well, that's great. A great update across the board. A lot to unpack. And I just want to share my screen real quick to go back what you said, where like I'm looking at the MREL, your REIT ETF, but we'll look at RS in a second because the graph looks very similar. And it's exactly what you said here. So there was a big run up in July, August, September, and then the announcement with the immigration, and then we're going back down again. And it was even more pronounced with RS, of course, because it's a leverage, it's leverage,
You
so
got it.
it has a lot of the same REITs. One thing I want to ask you about, because you're an expert in this, I'm definitely not. When you say discount to NAV, so REITs are, there's a .un. These are trusts, so there's a net asset value, which is literally correct me if I'm wrong here, the intrinsic value of a share or a unit in this case. And what do you mean when you say there's a 20 or 20, 30% discount? What do you mean by that exactly? If you could.
Okay, so let's, as you say, unpack this. So what is the net asset value? So for a REIT that we own in our portfolio, it's priced at $18 a share, for example, and we own 100 or 200,000 shares of that particular REIT. So we've got roughly, depending on the portfolio, like MREL, we've got maybe 30 to 35 of those companies in our portfolio, which you say are structured as trusts. And then what we do is that we take that total value of that portfolio and we say, what is the value of that portfolio in MREL? And that comes out with our net asset value. That's really what it is. So that is the value of that portfolio. So the trading price for any one of those individual REITs
Yeah.
is different from what the net asset value is for one of those individual REITs. So as I mentioned, let's say a REIT is trading at $18, and that's where we've got it valued in our portfolio. But once you actually calculate its assets, its properties, so in the case of, say, a retail REIT, you add up the value of all of its shopping centers,
Yeah.
less any of the liabilities, the debt on those shopping centers, it may have a net asset value that might be $22 or $23. But the market is only paying or prepared to pay $18. So that difference between 18 and 22 is what we call the discount. Now, there have been times historically, Adriano, where these REITs have traded at net asset value, so in this case, $22, or sometimes even above.
Premium.
And in a more normalized market where you don't have the kind of volatility that we've had in the last 2 to 3 years in interest rates, these things have historically traded right around net asset value. So when I look at that historically, and I look at today's environment where rates are actually coming down, no longer going up, I'm feeling more optimistic that they're going to start migrating up to that $22 in this example net asset value of what we think that REIT is worth.
Do you have some sort of prediction timeline? Do you think it'll just be a matter of when, those institutions realize it? What do you think the fear is right now since, typically when you hear interest rates going down, that's really, really good for REITs. Is it because there's also a delay with it taking effect? So maybe you
Yeah,
could just quickly, how do interest rates going down, how does that impact a REIT like a RioCan or a Cap REIT,
sure.
like off the
So
bat?
specifically with any one of the REITs, the REITs typically, when you think about the value of the assets on their balance sheet, approximately 40 to 45% on average of those assets are financed through debt. So they
Right.
borrow the money to buy those assets. Now, and that borrowing is often in the form of longer term debt. So these are debt instruments that are maturing beyond 1 year, and they're typically at a fixed rate. And then they've also borrowed on a short-term basis. So for an individual, like on a line of credit, that is typically subject to rates that are more variable. So whatever the short-term rate is. So as a result of rates coming down, their short-term borrowings are actually the cost of that is coming down. And then as well, when they're renewing their longer-term debt, and they've all got that debt staggered over time, then
Uh,
that debt is also maturing at whatever the prevailing rate is if they choose to renew it at a 4, 5, or even 10-year basis at that point. So lower interest rates reduce the cost of borrowing, which then provides more cash flow available to pay higher dividends or to make acquisitions or to buy more shopping centers in the case of RioCan. All of that is in fact what's at play here with shorter rates. Now, that's how shorter rates actually affect the REIT. But the other factor that's important, which I alluded to, is that the REITs are also going to be benefiting from shorter rates, lower interest rates from individuals. Because again, over the last 2 to 3 years, a lot of individuals have taken their money out of dividend paying stocks and have put them in their bank just to buy a GIC. Now, as those GIC rates come down, so if I had a 2 year GIC or a 1 year GIC that was at 5.5%, renewing in the next 6 months at 3%, I'm going to say, wow, that's not high enough for me, especially when inflation's at 2%. I'm going to be looking to buy something else where I can get a higher level of income, like MREL or one of the REITs directly, and they're trading at a discount to what they're worth. That's a good value proposition for me. So there's two real impacts of lower interest rates: one on the REIT itself, and two on the investor who's now looking for alternative forms of income that provide a higher yield.
right. I heard the same thing about dividend stocks in general, or with Rob when we talked about Enbridge as well, right? People
Correct.
getting out of dividend stocks, going with GICs, but when the opposite happens, they come back because they're not really interested in 3%. Okay, so it's twofold. So they save on their financing for the portion that's variable, it's right away. But then as those fixed term mortgages, whether it's a year, like you said, it's staggered, that they'll renew another, 5-year mortgage at a much lower rate. So you think maybe this is why it actually takes time, and when a rate announcement is, a rate lowering is announced, it's not like an instant boom. That's probably why, right? It takes maybe
That's certainly one of the factors, absolutely. And then the other thing is, what we often focus on is, okay, what's going to be a catalyst for
hmm
these REITs to start trading closer to what we think they're worth, i.e., what their net asset value is. And sometimes, Adriano, is just a large M&A opportunity, something that might get announced, whether that's a private equity player like TPG or who just bought the manufactured home portfolio from CapREIT, or a Blackstone who might come in and they've made a couple of acquisitions. They bought Tricon earlier this year because if they're going to take one of these REITs and take them private, I actually buy 100% of them. They're going to have to pay a premium. The board of the REIT is not going to sell these assets for anything, materially less than what they think they're worth. So
Right.
the private equity player will have to pay up. And that kind of stuff then becomes validation that those net asset values are actually real. And that then drives a lot of buying activity because investors say, okay, if Blackstone bought ABC REIT, this REIT is also trading at a discount. A lot of investors then take the money out of ABC REIT and start buying that one. So that then just feeds on itself. So that's another potential catalyst that I think could happen here in 2025, especially given how deeply discounted some of these REITs are trading.
Awesome. Awesome. I think that's all the question. You answered everything and it makes complete sense. So if we let's talk about RS now, if you don't mind. So RS is my personal favorite REIT type instrument because it's a split fund, which means it's leverage. I'm talking about the Class A shares here, of course. And you guys recently completed a merger with another closed-end fund that merged into this one. So right off the bat, how RS grew? How much did it grow in terms of AUM approximately with the merger?
Yeah, I think the net increase was somewhere around 20 to 25 million or so, roughly. So not that significant. And the RA portfolio was, had significant overlap in terms of the names that were in RA that then came into RS on the merger.
Yeah, and I got the top 10 holdings here in front of me. So you got, these are all big cap blue chip REITs, I call them. We discussed this before. You guys are not really into office REITs that much here. I don't think there are any at all. It looks like it's mostly multifamily and in a lot of industrial like Dream and Granite. And, you got the apartment buildings, Cap REIT, Rio Can, Boardwalk REIT. So what's your, on these REITs here? I mean, what can you go through the selection? I mean, we talked about this before, but maybe reiterate how are you choosing these REITs here in both MREL and RS as well?
Yeah, so first and foremost, we have a focus on quality. We typically only really buy what we think are high quality issuers. So, for example, there might be a lesser quality issuer trading at a very high yield. That's typically not the type of REIT that we would buy. So, often you're chasing yield or high yields. That's usually telling you that there's an issue with the business, that the market is actually not prepared to take a lot of risk on this name without being compensated by paying them a higher yield. So we're not necessarily and very seldom chase yield. So CAPREIT, one of the largest weightings, when I see this kind of company trading now in the mid 40s, like it's just it is the preeminent multifamily REIT in Canada. It's really cleaning up its portfolio. And again, with the impact of these reduced immigration targets, that stock is traded down to a point, Adriano, where I think it just represents excellent value. I could make the same point for some of the industrial REITs like a Granite. I think it's really cheap and it's been really punished, not necessarily by immigration, but some oversupply of new industrial properties being built, but that's now being absorbed. And I think some of its US exposure, once it announces some leases, probably in the first half of next year on some of its US names, I think Granite's going to perform very well. One of the biggest winners in the portfolio this year have been the senior living REITs, specifically Chartwell, Sienna, generally speaking, have done extreme rebounding from the depressed valuations and fundamentals that you actually saw during COVID. So I've just met with those companies in the last few weeks, and again, the occupancy gains continue to be very significant. So we still have a very positive outlook for some of those names. And then last but not least, you've got some of the multifamily beyond cap rate, which again are trading at what I think are 30 and 35% discounts to NAV. They're overly punitive that I think, are going to start to recover as we go into 2025 once people realize that, these reductions in immigration, are not going to be as bad as, the worst case scenario is being priced in.
Yeah, yeah, you got a lot of apartment REITs here. I see chart, here's the senior, I believe, resident one, Chartwell. And these are really the big ones, really popular ones. You got Choice, which has a bit of everything. Here's
Correct.
Inter-Rent, Killam Apartment REIT, these are all apartments. So it seems like it's all very high quality, either apartment or industrial, with not much office. So the quality is there. I'm just curious. There's 87% Canada, 12% US. So what exactly do you have in the US? Is this post merger that there's a little bit of that private REIT that was there,
Yeah,
or is
we,
it
we,
something
we
else?
do hold a bit of a Blackstone private REIT, which
Okay.
is a high quality portfolio in North America, primarily comprising, multifamily, industrial, some cell towers, some student housing, areas that, we think the fundamentals are good. But by and large, that US portfolio is some of the cell towers and, those kind of names that we think are well positioned. I think when you think about the US market, we're really trying to identify areas that, we can't necessarily get in the Canadian publicly listed REIT market. So that's
Okay.
why we would go to the US.
That's good. Diversification is good. And I noticed there's 8.70% in financials. I'm assuming that's maybe a REIT financing type company, maybe that lends money. Is that correct? I don't see it in the top line.
Yeah, so what that is again, it's a bit of an indirect way to play real estate, and we own companies like Blackstone and Brookfield that are major real estate investors, but are characterized as financials in the GICs. But they are really an interesting derivative way to get exposure to real estate, and they're amongst the biggest private investors in the world.
Awesome. Awesome. Okay, and as far as just wrapping up here on RS, it is a split fund, and even though it's been under pressure, I feel like it's only trading at a 5% approximately premium here based on the numbers here. I've seen it at a much higher premium, so obviously there's good opportunity here. And just to reiterate, as long as the unit NAV, which is 1051 plus 1011, is above $15, you guys are gonna continue paying out that monthly 13 cents a month.
Yeah, we don't have any plan right now to uh, change the dividends on the Class A units.
Okay, perfect. So, Dean, I think you answered all the questions. Obviously, it seems like there's a lot of opportunity. You've been in the real estate game for decades now. Would you say this is the best opportunity since 2008? Where are you at right now in terms of the valuations? Like you talked about that the 20-30% discounts and that. Is this the best deals you've seen for how long? Since when? Just to give the audience
Yes.
perspective.
So from a fundamentals perspective, when I think about the core areas where we have exposure,
Mhm.
fundamentals are as good as I've seen them in a long time. Like even with the curtailments in immigration, we still have a significant housing shortage in this country, and I think the multifamily REITs will continue to be well positioned. On the retail, Adriano, it's just we haven't been building any new retail shopping centers, grocery anchored shopping centers. So you've got growing demand, limited supply. As I say, on industrial, you've seen some growth in supply, but that's all going to be absorbed, I think, over the next 12 months or so, and they're not building any new ones. And then, last but not least is the seniors housing. And again, it's difficult to build a new seniors housing complex. One of the CEOs said a few weeks ago that if he was to build a new seniors home today, he'd have to be, it would cost him somewhere between 800,000 to $1.2 million per room to build a new seniors home, which means that if he built it, they would have to charge somewhere around $13,000 a month to a retiree in rent in order to make a reasonable return on that cost, that investment. It's just not going to happen.
That's not gonna work.
So you've got high cost of construction, you've got high costs of land. It takes a long time to get these things built. Hence, supply is very constrained while demand continues to be relatively strong. So, getting back to your question, these fundamentals are extremely good. And just given some of the noise that we've seen over the last 3 or 4 months, immigration and rates, you've now got these things trading at very attractive price levels.
Okay, makes sense. And I'm just curious, you're talking about the noise in the last 3-4 months. There's been a lot of noise in the last 24 hours related
24
to
hours,
the
yeah.
federal government and Trudeau and Freeland resigning, and you got the housing guy resigning. It's been pretty crazy. So it seems to me like there's going to be a change of administration very, very soon next year. How do you think that's going to impact? Because if we're going more towards a conservative government, we know that they're more slashing regulations and slashing taxes. Is that overall good for real estate, the REIT industry? Do you see that as a headwind or a tailwind, as they say?
Yeah, it's a good question. I think it would become more of a tailwind because the existing Liberal government's been there a long time. I would agree with you. It seems like we're going to get an election sooner than we'd actually thought. And if we believe in the polls, then I think the Conservatives, likely get in here. And they seem to be a more pro-business, lower regulation, kind of, lower cost overall. So I think as a result, they're going to be likely more um, um, their position in government will be viewed more positively by investors, both in Canada and maybe more importantly abroad. So I think that on balance would be good for any sector, including real estate in Canada.
Awesome. Awesome. Well, Dean, you've been great as usual. Thanks so much for the real estate update. I'll have you on more often if you can. So I really appreciate it. And just to my audience, don't forget, guys, Middlefield has two ways you could invest in real estate. You got MREL, which is award-winning REIT ETF. No leverage. It's not a split fund or anything like that. And then if you're even more bullish on real estate, you want a little bit of leverage in there, like I have, you could get RS, which has a lot of the same names, which recently did its merger, which is only at about 5% premium right now. And you're looking in the 13, 14% yields, which is really, really, really attractive considering the big discount. So Dean, again, thank you so much and hope to see you again. If I don't see you, happy holidays, Merry Christmas, and Happy New Year as well.
Same to you, Adriano. Merry Christmas and have a great 2025. Look forward to chatting again.
Yeah, thank you. Take care.